Hello everybody, welcome to my channel. My name is Domenico and today we'll be looking at who should be investing in index funds and who should be investing in individual stocks. So we'll be cutting the board in half here and we'll be looking at each one separately. Okay, so we'll be starting with index funds. So index funds, first I'll explain what it is and then I will compare the two. So I'll explain each one and then compare the two based on each point. So the index fund is a collection of pre-picked stocks. Each one has a weighting, a certain weighting, and then you have a certain price, and you can buy into this index fund using certain ETFs, which is an exchange-traded fund, and you basically go with the entire market. So it's a big collection of diverse companies that you can invest in straight away. So let's just put in that it's a collection of stocks. Okay, so that's first. Okay, so it's a collection of stocks. You're investing in a group of stocks already predetermined for you. Now, these index funds are seen as a generally safer alternative to picking your own stocks. So let's put safer. And let's put this in quotation marks because people say it's safer, but let's just go with that. Okay. Now, index funds basically have a return on average of about 8% per year, 7 to 8% per year. So let's go to 8% return per year. Okay. So this, if you put in $100 at the end of the year, you should expect to have $108 on average. There are some years that it goes down, some years that it goes up. Now, this exchange index funds basically trace or track the entire economy of where that index fund is found. So basically, if you invest in the S&P 500, on average, it will basically track the economy of the U.S. So if the U.S. economy is doing very well, if unemployment numbers are really low, if there's a lot of new jobs, if there's a lot of home sales, if the economy is rolling very well, usually the index fund will track that and it will do very well as well. Now, if there are certain events that occur, maybe terrorist attacks, or they could be many different things like the trade war with China right now, the index fund will reflect that. So when the trade war started, the index fund did suffer and it did go down a little. So let's just go with tracks general economy. Okay, so basically that's what an index fund is. So it's a collection of stocks. It's generally seen as being safer than picking your own stocks. 8% return per year, so not amazing, but then again, when you look at a savings account in a bank, that's 1%. So you're doing very well for yourself if you want an index fund. And little research. Okay, so you don't really need to do much research for an index fund. You just put your money there and you just continue adding in money as you make more money. All right, now let's get to individual stocks. So let's see individual stocks. Okay, so let's see the difference between the individual stocks and the index funds. So individual stocks, you have to pick your own stocks. So basically, they are any company you can think of that is public, meaning it has shareholders, will be considered an individual stock. That is an individual stock. Now, let's say a Coca-Cola, an Apple, Facebook, Amazon, Google. All those companies are individual stocks. So we can say it is one stock. Okay, so it's one stock. We're representing one company. Okay, so it's one stock representing one company. Okay, so let's just think of this in general terms. Now, if you invest in a one given company, now you're picking this company and you're not forced to invest in any given company. So let's say you pick a Facebook, and Facebook, the business is doing very bad. And you're seeing this and you're going, oh no, I think the stock price is going to go down. Well, in the long term, if Facebook doesn't do well, the stock will suffer. And same, if Facebook does very well, the stock will also appreciate, like how the company is doing well. So if you look at a stock, you can say it's more risky, but not really. If you pick the right stock, if you look at all the metrics, if you look at the PE ratios, if you look at the returns, the EPS, the forward PE, if you look at all these things, then it's not really much riskier. But then again, it is riskier because you're not as diversified. When you invest in individual stocks, you have to make your own portfolio. You have to create your own portfolio. You have to invest in several different stocks. You don't just stick your money in one stock and then boom, that's it. No, you gotta diversify. You have to know what you're doing. It's a little more complex than index funds. So we're gonna put riskier in brackets, but it depends what you're doing as well. So let's put riskier and let's just leave it at that. Now, returns can vary significantly with individual stocks. So with index funds, no matter who's investing in index funds, if it's you or if it's the guy next door, if you're both investing in a Dow, you're both going to have the same return at the end of the year. Now, if you're individual stock pickers, you will not have the same return. So there can be one person picking his stocks and he picks terrible stocks all the time. He never does his research, all that. So he gets a negative 10% return per year, and he's a terrible stock picker. If you see yourself getting negative returns or returns less than or almost equal to 8%, just stick your money in an index fund. It's a lot less risky. It's a lot more diversified. You already have your work cut out for you. So just put it in the index fund and you don't even have to do any work. Just stick it in the index fund if you're making anywhere close to 8% or less. If you're making less, for sure, stick it in the index fund. With individual stocks, you want to aim for at least 12 to 15% per year. Generally, anything above 20%, you're a fantastic investor. It's something that you're looking up to, like a Warren Buffett, for example. He gets about 23% return per year. That's phenomenal. But as long as you're making 10 to 15% per year, individual stock picker is for you. If you do all your research, it's for you. So we can say that aim 10 to 15% per year, but varies. So it varies drastically depending how good of an investor you are, how much research you do. This really depends on your work. The work you put in, usually corresponds to your return. Then again, you can make a bad business decision. You can invest in a company that is doing very poorly, and that's not your fault. That has nothing to do with the research you put into the company. It's just you just got unlucky, and it happens sometimes in the stock market. The stock market, no one can predict the future. If a company you invest in has a bad management team, first of all, never invest in that company. But sometimes you don't know from the get-go, and sometimes you think it has a good management company and it doesn't. So you have to always aim for 10 to 15%, but never rely on it. Never say, I'm going to get it, or you never know. You never know with the stock market. It's always a risk. There's always a risk. Even with index funds, it's always a risk. And there is nothing certain in the stock market. Basically, tracks the general economy. This has nothing to do with the economy. There are some companies that do very well in a recession. Some companies, when a recession comes, they do even better than in a good economy because people start flooding money into these companies because they're seen as safer companies. They have better balance sheets. It's generally seen as the fittest wins, basically. So survival of the fittest. So this has nothing to do with the economy. Nothing to do with economy. So it does have something to do with the economy in the sense that if the economy is doing poorly, the business might suffer because let's say if we look at a Michael Kors, let's say, and you have a Michael Kors, and then you have a smaller brand that makes purses, let's say, and they sell for much cheaper. Well, you're gonna obviously see that company selling the much cheaper purses increase their revenues in a recession because Michael Kors has some market share right now, but in a recession, not many people will be buying Michael Kors purses. I can guarantee you that much. So basically, it has something to do with the economy, but if you're going into a good company with a good balance sheet, you have nothing to worry about. No matter how good or bad the economy is, your company will more than likely do very well for itself in the long term. And then you have tons of research to do with this. So tons of research. So with individual stocks, every single day, you're looking at 10Qs, 10Ks, listening to conference calls, you're reading annual reports. I mean, just looking at, for me, for example, I have tons and tons of annual reports right next to me at all times. So I'm always reading annual reports, and it's something that any individual stock picker has to do. You always have to look at these things. You always have to look at new businesses, try to get new ideas for more investments. When you have money, so let's say you're ready to invest, you have to filter all these companies to see where is your money best put. Where will you be getting the best return on your capital? So let's compare individual to index funds. Now, if it's someone that's working a 9-to-5 job and they're really tired after their job, they really don't have time to do any more research, they just want to lie down, stay on the couch, watch TV, that's perfectly fine. Everyone has their own opinion of how to live their life and what makes them the most happy in life. So if it's someone like that that really doesn't feel like doing extra research, index fund is for you. Now, index funds, you just want to pick one good index fund. Usually it's going to be the S&P 500. You're going to take an ETF that tracks that S&P 500. Vanguard also has a very good one. VOO, ticker symbol VOO. So if you're someone like that, you want to invest in an index fund. It's just a much safer investment. You don't have to do any research. You just put your money in there and you're done. Individual stocks, someone who is looking for getting bigger returns, better returns than 8%. 8% is still very good. When you think about compound interest, 8% per year on average is very good. It's much better than a savings account at 1%. But individual stocks is for someone looking for 10 to 15% per year, if not more. If you are a great investor, you can aim for 20, 25%. But that's not really realistic because Warren Buffett gets about 23, 24. So this is for someone that has the work ethic to put in. You have plenty of time to do some research. You're okay with doing research. When you get home from work, you're straight on the research. Listen to conference calls, 10Qs, 10Ks, all this good stuff. And you have to enjoy it. If you don't enjoy it, you will never be successful in the individual stocks. You never want to, you'll have to have your own mind. Individual stocks, there can be someone bashing your stock on TV, CNBC. They're bashing your stock. You know, let's say, for example, a Tesla. I'm invested in Tesla. I've been invested for quite a while now through all the bad news. And it seems like every single day that there's someone coming out and bashing Tesla for how bad or no demand or this and that. You have to have your own mind. You have to think for yourself in this game, and you have to really believe in yourself, and you have to have confidence in your own thinking. So that's something with this. With this, in the index funds, I mean, there are people that say get out of the market because it's going to tank or this and that and this and that. But that's just in general. But individual stocks, you can get attacked personally on your stock, and you still have to stay on it, and you have to believe in yourself. And yeah, you have to stick tight with this one. So it really depends where you're looking at. If you want to get more returns, you have to put in more work. And it's just normal common sense. So that's pretty much the difference between individual stocks and index funds. Hope you enjoyed the video, guys. Don't forget to leave a comment on which one you guys personally take. Are you guys individual stock pickers, or you just put your money in an index fund to get an average of 8% per year? Both of them are perfectly fine. I just want to know what you guys prefer and what you guys see fit for your guys' lifestyle. Don't forget to leave a like. It really helps the YouTube algorithm to get my videos out there. And subscribe if you haven't already to get more videos like this in the future. Alright, guys. Till next video. Peace.